Certain assets make you rich, and in this video we will discuss with you the 9 assets that will make you rich. The multi-billionaires also invest in these assets. Keep watching this video till the end. Now let's begin. Number 1. High-yield savings accounts. These accounts function similarly to savings accounts, yet they offer a superior interest rate. In 2024, we anticipate that high-yield savings accounts could yield returns exceeding 5%. At a 5.75% interest rate, a balance of $1,000 in your high-yield savings account can yield an annual return of $57.5, assuming interest is compounded annually. They offer adaptability without fixed durations. Funds can be accessed without incurring any penalties. Keep in mind that cash withdrawals can impact profitability. Interest accrues solely on funds held in the account. Your investment of $250,000 is safeguarded with FDIC protection. Interest rates are subject to change. Should interest rates decline, it may be prudent to consider transitioning to a different bank for more favorable rates. Inquire with your bank regarding alternatives for high-yield savings accounts if that is your interest. Conducting online searches can uncover the bank with the highest yields. Initiate the process by setting up an account, facilitate seamless cash transfers, monitor the growth of your assets, and capitalize on passive income opportunities. Number 2. Money market accounts. These accounts integrate the advantages of both savings and checking accounts. They generally offer elevated interest rates as a reward for sustaining larger balances. They create a stream of passive income by strategically managing the interest rate on the funds within the account. For example, with a balance of $1,000 in your money market account at a 5% interest rate, you stand to earn $50 annually by maintaining the funds in the account and letting the interest compound each year, with the potential for even greater returns if compounded quarterly or monthly. A money market account offers you the advantage of immediate access to your funds along with the capability to write checks. Your funds are safeguarded up to $250,000 through FDIC insurance, ensuring an enhanced level of security. Interest rates may vary based on prevailing market conditions. When considering the establishment of a money market account, it is essential to conduct thorough online research to identify the bank that provides the most appropriate option tailored to your unique requirements. First, establish your account, move your capital, and observe the expansion of your assets. For those interested in discovering exceptional assets and strategies to enhance your income, I encourage you to subscribe to our channel and show your support by hitting the like button. Number 3. Certificates of deposit. Certificates of deposit are structured financial instruments that come with predetermined durations and provide guaranteed interest rates. The timeline may range from a few months to multiple years. At the conclusion of a CD's term, you will receive the initial principal amount in addition to the interest that has accrued. Currently, 1-year CDs are yielding around 5%. Investing $1,000 into the account and allowing it to remain untouched for a year will yield an expected return of $1,050 at the end of that period based on annual interest calculations. This investment guarantees a secure return, backed by FDIC insurance, while also delivering competitive interest rates for extended durations. We are facing a potential risk of inflation, which could result in interest rates failing to keep up with the increasing prices. For those considering a CD, it is essential to conduct thorough online research to pinpoint the bank that offers the most appropriate money CD tailored to your unique requirements. It is crucial to thoroughly assess the potential risks linked to having your funds secured, alongside the benefits of obtaining a guaranteed interest rate. Number 4. US savings bonds. These government bonds offer a reliable interest rate over a defined period. You are effectively establishing a lending agreement with the US government. We recognize 2 primary categories, Series E and Series I bonds, each offering unique characteristics. The current interest rate for I bonds stands at 5.27%, whereas EE bonds offer a lower rate of 2.7%. Series I bonds serve as a strategic hedge against inflation. State and local income taxes on earnings are non-existent, though federal tax remains applicable. Conversely, it presents comparatively lower returns in relation to other securities. For those looking to open a US savings bond, I recommend visiting treasurydirect.gov for further information and guidance. Thorough research and a comprehensive understanding of both advantages and disadvantages are essential. First, set up your account, select the bonds that meet your strategic objectives, and move forward with your acquisition. You are now entitled to funds from the US government. Number 5. Corporate bonds. Both private and public entities engage in the issuance of corporate bonds. Acquiring a corporate bond means you are providing capital to the firm. This agreement encompasses consistent interest payments along with the complete face value of the bond upon maturity. Corporate bonds frequently deliver superior performance compared to government bonds. Incorporating corporate bonds alongside other assets can effectively reduce portfolio risk. They offer a range of bonds, including those that are safer with lower yields and others that carry higher risks with the potential for greater returns. The collapse of a corporation could result in significant losses for investors. Corporate bonds or bond ETFs can be obtained through a brokerage platform. A thorough analysis is essential to grasp the issuer's financial position and the bond issuance process. Explore financial news outlets and business evaluation entities. Industry specialists provide invaluable guidance in selecting the most effective investing strategy, akin to the role of a financial advisor. Initiate the process by establishing a brokerage account when prepared. Choose bonds that align with your risk appetite and financial objectives. Make your acquisition today. It's time to focus on corporate financing as your next strategic move. Number 6. Stocks that demonstrate increasing dividends. These stocks originate from companies that consistently increase their dividends. There is a strong presence of financially robust companies in the market. These equities integrate dividends with capital appreciation. The consistent increase in dividends from these equities often indicates a robust and expanding organization. The previous dividend distributions of the company suggest a potential for sustained quarterly income from dividend-paying stocks. This facilitates effective budgeting and strategic planning. Consider acquiring additional shares through dividend reinvestment, as this strategy can enhance the value of your investment over time. Taxation occurs upon receipt of dividends rather than at the point of asset sale. Individuals in elevated tax brackets must assess the potential impact on their yearly tax obligations. The primary avenue for investing in dividend growth stocks is through brokerage services. Number 7. Growth stocks. Investing in growth stocks entails acquiring shares in companies anticipated to achieve above-average sales and earnings growth. These organizations generally allocate their profits back into the enterprise, fostering further growth and expansion. In contrast to dividend growth stocks typically do not provide dividend distributions. They present a chance for substantial capital appreciation as the company's value and share price increase. Within fast-growing industries, these stocks are often identified. Investing in growth stocks presents a significant opportunity for capital appreciation contingent upon the companies realizing their growth potential. Allocating your resources strategically can lead to substantial growth over time, especially in innovative sectors or advanced technologies. Organizations identified as growth stocks often lead their sectors, driving and shaping trends, which can lead to increased market valuations. Number 8. Exchange-traded funds. It represents a strategic investment vehicle that can be traded on stock exchanges, akin to individual stocks. An ETF generally comprises a diverse range of assets, such as stocks, commodities, or bonds. ETFs offer a cost-effective approach to gaining exposure to a broad spectrum of indices, sectors, or varied investment strategies. Investing in an ETF offers the advantage of diversification, effectively reducing the risks tied to individual investments. ETFs typically offer reduced fees in comparison to mutual funds and necessitate a smaller minimum investment. As with any investment, ETFs carry market risks, including those linked to the underlying securities. Prior to engaging with ETFs, it is essential to clearly define your financial goals and assess your risk tolerance. Invest the necessary time to thoroughly evaluate different ETFs and pinpoint those that best align with your strategic investment goals. Number 9. Peer-to-peer P2P lending. P2P lending enables individuals to engage in borrowing and lending transactions directly, eliminating the need for intermediaries. Our internet services strategically connect borrowers with investors, fostering a dynamic marketplace. This option allows borrowers to secure funding from individual investors at a rate that both parties find acceptable. Now, please subscribe to our channel to help us hit our first 1,000 subscribers goal.